Ladies and gentlemen, and welcome to our webinar sponsored by TradeTime, one of the world's leading forex and CFD providers. Tonight's class is about Fibonacci levels, and we're going to spend a little time looking at using them with cryptocurrency. Now, tonight's class is sponsored by TradeTime, one of the most unique trading platform providers out there. They allow you to customize and define your trading objectives, your account type, your dashboard, what information you're going to get, how you're going to get your emails, how you're going to get your notification. Everything is designed for you and your trading style. So you have full account customization. You have an extensive range of trading tools, including daily analysis, weekly reviews, focus articles, and live signals. You are trading with a regulated provider, so your funds are all secured and segregated, and you have a proprietary TradeTime platform built to the highest industry standards and customized for you. It's easy to see, it's easy to read, it's dynamic, and it's comfortable. They have one of the most advanced online trading platforms as well as mobile platforms that you can find. It's intuitive and user-friendly. They have advanced charts and indicators, and you can customize your alerts to notify you of any market events that you care to be aware of. They also offer you live signals, but not just telling you what asset to trade. They tell you what the first objective is, what the second, where to put your stop loss. They also tell you how many other traders on the platform have actually traded that signal since it was issued. So you can see if all the other traders are trading and jumping on that signal, or is it just one that everybody's ignoring? You decide what you want to do. So if you want, while we're in class tonight, go to www.tradetime.com and start customizing your own platform. There's no credit card required, no deposit required. Just open up a demo account and you'll be able to customize it to make it fully personalized. And then you can also change it to whatever you want, but it'll give you a chance to see all their tools and understand what this unique feature is. And you'll get to take a look at their next generation trading platform. Now, tonight's class is being recorded, and if you want to see a recorded version of this class in about 24 hours, you can go to investing.com where you enroll in the webinar and look for the education tab and then go to webinars on demand and find tonight's class. But it'll take us about 24 hours to get it there. So let's get started talking about Fibonacci levels and cryptocurrency. Now, it's important to understand whether you're trading Bitcoin or you're trading the Euro US dollar, whether you're trading a stock or whether you're trading the S&P 500. There are certain levels and certain prices that are strategically important. Now, there's no guarantee, but what we look for in the markets are levels of support and resistance. Now, these come in many fashions, but these are prices that in the past that the markets have had a problem pushing through or falling below. And the more ways that we can find to find these levels, the more we can isolate or determine a zone in which we can expect some market reaction. Now, the thing is, when you're trading cryptocurrencies, you can only basically rely on technical analysis because Bitcoin or Ethereum or Bitcoin Cash or Ripple, they're not part of an economic system. They're not part of a government. So they don't respond to unemployment figures. They don't respond to central banks' interest rate hikes. They don't respond to inflation data. So we have to figure out what they do respond to. Now we know there are news headlines that can send Bitcoin falling or Bitcoin soaring, but we can't figure out what these are because we don't understand what the effects are. So last week we saw a big exchange hacked. It actually had a very negative effect on the markets, but we couldn't judge it. We didn't, and you can't even see when that effect is going to happen. We saw on Thursday and Friday some U.S. credit card companies saying that they will no longer process charges for cryptocurrency purchases. It was a negative comment. You would have expected it to send Bitcoin tanking, but the markets made no reaction to it. So For cryptocurrency, we can't really isolate how the markets react to news headlines because we have no estimation. We have no history. We have no way to gauge these. So the only way you can successfully trade cryptocurrency is with technical analysis. And the fact is, even applying technical analysis, the currencies are so new that there is no historic prices. There's no what was it trading at last year at this time, or when now, yes, we can see when Bitcoin was last trading at 8,500, what were the prices around it that were important, but that was only last month. We can't go back to last year and the year before and the year before. We can't even really look at chart patterns. So we're limited in what we can use to actually make determinations. And we are stuck with several types of technical analysis. And one of those that works very well is Fibonacci retracements and Fibonacci levels. Now, Fibonacci retracements are ratios used to identify potential reversal levels. These ratios are found in what's called the Fibonacci sequence. The most popular Fibonacci retracement levels are 61.8, 30, and 38.2, and then 50%. But 50% is not a Fibonacci calculation level. It's just because it is such a common level that 38, 50, and 61.8 are the most important retracement levels. Now, when we talk about the level of 61.8, it is the price should retrace to its prior move by 61.8% or 50% or 38.2. So in other words, when the euro rallied from 119 to 124, if it was going to retrace and come down, it would fall from that actual move by to the 61.8% of that move, then to 50% of that move, prior move, and then to 38% of the prior move. Okay. Now, these numbers come from what's known as the golden ratio or the Fibonacci sequence. There are plenty of sources on the details of where all this comes from. Okay. But they were developed in Italy back in 1170 to 1250 by a mathematician in Pisa who's credited with introducing the Fibonacci sequence. Okay. Now, this is a sequence of numbers. It starts out with 0. Then that number is added to the next number. So the next is 1. Then 1 and 1 are added together, it gets 2. Then 1 and 2 are added together, it gets 3. 2 and 3 are added together, it gives 5. 3 and 5 are together, added 8. 8 and 5 are added together, give you 13. And then 13 is added to 8, it gives you 21. Okay, so it is the preceding number and the current number added together to give you the next. And this is what's known as the Fibonacci sequence. Now, this ratio or the sequence extends on into infinity, and we would say, that's a bunch of garbage. But when we take this sequence of these numbers and apply it to all kinds of things all over the world, they all fall into the same sequence. If we look at the spirals on a seashell, we look at the placement between your eyes and your nose, you look at how electrons are calculated, they all fall into the same sequence. Nobody knows exactly why. But the sequence of 1.618 refers to the golden ratio or the golden mean, which is sometimes called phi. The inverse of the 161 is 618. These ratios can be found throughout nature, architecture, and art. The proportion of 0.618 to 1 is the mathematical basis for the shape of playing cards, of the Parthenon, of sunflowers, of snail shells, Greek vases, and the spirals of galaxy in outer space. Why? We don't know. We just know that they occur all throughout the universe. Now, when we apply them to the financial markets, we can see that an asset will often pull back or retrace a percentage of its previous move before reversing. These Fibonacci retracements often occur at three levels: 38.2, 50, and 61.8. Actually, like I said earlier, the 50 level really does not have anything to do with Fibonacci, but traders use this level because of the tendency of an asset to reverse after retracing 50% of its previous move. So let's talk about some examples. So in other words, we can see here in this move here, when that asset eased, it retraced 38.2% of the total move up. In this case, that same movement, it retraced 50% and then continued on its trend. Here it retraced 61.8 of its prior move and then continued on this trend. These retracement levels give us potential levels of support and resistance. Because if you remember, or if you understand price movement and trends, price moves in push, ease, push, ease, push, ease, push, ease. If each one of these pushes was considered a previous level, we would expect that ease to be either 38.2, 50, or 61.8. If it didn't rebound at 38.2, we'd expect it to look, or we would look for that next level of 50%, and then we'd look for that next level of 61.8 and expect it to bounce off of those levels. Now, this picture shows a graphical representation of the reversal points for a stock in an uptrend. The pattern is reversed for stocks that are in a downtrend. So you flip them over. Whatever we apply for an uptrend just simply gets flipped over for a downtrend. So we expect 38.2 retracement, then 50, and then 61.8. In a downtrend, we would expect the exact opposite. Now, we have to learn. Now, the fact is, Fibonacci levels are quite complex in their calculations, and they used to be very difficult to even put on your charts. Today, they're simple because all of our new computerized charts just give us a way to grab the Fibonacci levels and drag them right onto our charts. So to do this, and we're going to go over to a live chart in a minute, to draw the fibs, we move from the swing high point to the swing low point, okay, of the previous trend action. Calculate the range from the swing point high to the swing point low. Now we would multiply these ranges by the Fibonacci retracement, 38.2, 50, and 61.8, but we don't have to do that anymore. Finally, subtract the number from the swing high that gives you the Fibonacci levels. Okay, we don't have to do that anymore. We simply locate the swing high and the swing low of the previous move, the previous trend, like you see on here. Let me get my marker on here. And then pull our Fibonacci level on here. So we locate the swing high, we locate the swing low of the previous trend. So we were in an uptrend. So this would have been the swing low of that previous uptrend. And then we have the swing high, not where it is now, where that uptrend reversed, because then we went into reversal. And we pull our Fibonacci tool onto our chart. And what it does, it automatically calculates the 0, the 38.2, the 50, the 61.8, and a 100% retracement. 100% is where the price retraced all the way down to where it started the previous uptrend. 38.2 is to this level, 38.2 of the move up. And as we can see in this example here, we retraced to the 50% and then rebounded back up. So order to find these Fibonacci retracements, you have to find, and let's mark this down, the recent significant swing high and swing low. Then for downtrends, click on the swing high and drag the cursor to the most recent swing low. If we're in an uptrend, do the opposite. Click on the swing low and drag the Fibonacci cursor to the most recent swing high. Okay, so we're going to go over to a chart right now. And we see that the euro is recovering from a downtrend and move back to an uptrend. We can see it currently in the uptrend right now. So we would look for the swing high from the last move. So we can identify that swing high here, and the swing low would have been here. This is where the trend started, and this is where the trend ended. And we use the word significant swing high and swing low. Just because the market freaked out or something happened to send an asset sky high for 1 second is not significant. So a blip isn't a significant. So here we have it's just the highest point or where the downtrend started. And here we have our significant or our swing low here. Okay. Now, we were in a downtrend, we moved to an uptrend. So hold on a second. I'm sorry, my screens are going crazy. Okay. So for a downtrend, we click on the swing high and drag the cursor to the most recent swing low. If we were looking at an uptrend, we would do the opposite. We would click on the swing low and drag the cursor to the most recent swing high. So in other words, if price had moved up and then fell back down, we would start with the swing low and pull our price to the swing high. In our case now, we are moving from the swing high because we just ended a downtrend, and we would pull it down to the swing low. Okay. So let's go back to our charts. And we've marked our significant swing high and swing low. So we just come over here to our drawing tool. We locate our Fibonacci retracement tool, click on it, and we pull it from the swing high to the swing low. And now look at what we have. We have our Fibonacci table put right on our chart with our levels all laid out for us. Over here. And where is it approaching? Is it approaching? Price is just approaching that 50% retracement, because remember, price pulled down, it retraced up to 50%. Okay, we could expect it to bounce off that 50% and continue the downtrend, or break through that 50% and continue the uptrend, because we are in an uptrend. So we can't use the current uptrend because we don't have an end of it. So we're using the previous downtrend. Now, in order to apply Fibonacci levels to your chart, you need to identify swing high and swing lows. A swing high is a candlestick with at least 2 lower highs on both the left and the right side. A swing low is a candlestick with at least 2 higher lows on both the left and the right side. If you're using candlesticks, like I said, I use what I call the significant swing high and swing low. And all of this depends on what time frame you're using, because Fibonacci goes on your chart based on the time frame that you're looking at your chart. So the euro, we could see, is moving in an uptrend at present. But if you looked at it in a 5-minute chart, it might be moving on a downtrend. So you need to use it appropriate for the chart you're using. When using Fibonacci tools, the probability of forex trading success could increase when used with other support and resistance levels, trend lines, and candlestick patterns for spotting entry or stop loss points. Now, Fibonacci retracement levels do not tell you to trade. They are not an entry and exit indicator. They are alert zones. Okay, they tell you, or they're helping you analyze the markets. Retracement levels alert traders to, or investors, of a potential trend reversal, resistance area, or support area. Retracements are based on the prior move. A bounce is expected to retrace a portion of the prior decline, while a correction is expected to retrace a portion of the prior advance. Once a pullback starts, charters can identify specific Fibonacci levels for monitoring. Okay. As the correction approaches these retracements, charters should become more alert for a potential bearish pullback or reversal. So the chart here shows what this shows, actually the S&P retracing. Here we have Home Depot. So we had price moved up in an uptrend. The uptrend ended. Okay, moved into a downtrend or a decline. And you can almost see this as the reverse of what we just saw in the euro. So we would take our Fibonacci level from here to here, and we would expect that price, because regardless of how big it is, we would expect our price to retrace to the 38.2 level, but it didn't. It fell right back down here to the 50% level. But look, when it hit the 50% level, it moved back up. Okay, so it bounced off that 50% level. So that is a decline. So it's either telling us that it's going to retrace or the trend reversal is over. But we don't know which it is, but it's alerting us to possible levels that we should be aware of, that we should be able to detect what is going to happen. Okay. Now keep in mind that these retracement levels are not hard reversal points. Instead, they serve as an alert zone for a potential reversal. It is at this point that traders should employ other aspects of technical analysis to identify or confirm a reversal. These may include candlesticks, price patterns, momentum oscillators, or moving averages. The Fibonacci retracement tool on most charts show at least 4 major areas. The 23.6 is also a common area, although it's forex traders and CFD traders pay very little attention to 23.6. Just like there's farther and smaller zones in between, 38.2, 50, and 61.8. From the Fibonacci section above, it is clear that 23.6, 38.2, 61 stem from the ratios found within the Fibonacci sequence. The 50% retracement level is not part of that sequence, but has been added in. So based on the depth, we can consider a 23.6 retracement as relatively shallow. Such retracements would be appropriate for flags or short pullbacks. Retracements to the 38.2 to 50% range would be considered moderate. And even though deeper, the 61.8 retracement can be referred to as the golden retracement, it is, after all, based on the golden ratio. So shallow retracements occur, but catching these require a close watch and quicker trigger fingers. But they're very hard to pick out because they are so shallow. So we use primarily, like I said, 38.2, 50, and 61.8. If you've been paying attention in class, you know by now that you can combine the Fibonacci tool with support and resistance levels and trend lines to create a simple but a super awesome trading strategy. So Right here, you can see the Fibonacci levels also combined with a falling wedge. Okay, and at the 61.8 is the expected retracement, and we're expecting the market to bounce back. We've used that with a simple stochastics RSI indicator, and we're expecting it to fall into the oversold area. At the same time, we're combining that with volume, and we see volume waning as prices move down. So that means traders are waiting for some pent-up reaction. We're expecting to react from the falling wedge, and that falling wedge happens to sit right at the 61.8. And we also have a simple moving average, and the moving average is still way above the price. But this is how it can be employed in a simple strategy with other indicators. Here we have another chart of Bitcoin using a much simpler strategy. And here we can see the retracement levels from the prior uptrend. Okay, Fibonacci retracements are dropped on the charts. We have our levels here. We've combined this with some other indicators. Again, we're using volume, and here we're using MACD, okay, to sort out some movement. We see retracement, recovery, retracement, push and ease, push and ease, push and ease, push and ease, push and ease. We now expect it. Now it's fallen, it's broken to 61.8, to 5, to 38.2. Price has fallen down to a very unused 78.6. But we could still use it, but most traders don't, because you can then go to 88.49, which are all Fibonacci levels. You can add on whatever levels you want in the Fibonacci sequence. Most traders don't use these other levels, but depends on your own personal strategy. Here we have a third chart showing Ethereum, and we have a nice little triangle built in here. We have our Fibonacci levels drawn on the chart. We have volume below, and it's a simplistic trading system. Okay, we can use these any which way we want. Okay, remember, they are like support and resistance zones. They give you alerts to specific prices that you're expecting to see some type of market action. And with cryptocurrencies, we need something because there is no other way for us to make any judgments. But remember, Fibonacci levels are not entry and exit points. They're not even, you could use them for your stop loss, but they aren't even used for that. They're just used for alert zones telling you to beware that something might be happening in the market. So let's go back to my PowerPoint again. So when combining the Fibonacci retracement tool with candlestick patterns, we are actually looking for exhaustive candlesticks. If you can tell when buying or selling pressure is exhausted, it can give you a clue for when price may continue trending. So Fibonacci levels work extremely well with candlesticks if you understand how to use the candlesticks and combine them and how to interpret and read them. But the first method is to set up your stops for using it for supporting your stops. Like I mentioned, you can use it to determine where you want to put your stops, is to set up your stop just past the next Fibonacci level. So if you're planning to enter the level at the 38.2 Fib level, then you could place your stop at the 50% level. If you felt like 50% level would hold, then you might place your stop at the 61.8. Okay, but it's not defined enough. Now, if you want to be a little bit safer, another way is to set your stops would be to place them past the most recent swing high or swing low. This type of stop placement would give your trade more room to breathe and give you a better chance for the market to move in your favor. The truth is, just like in combining the Fibonacci tool with support and resistance trend lines and candlesticks to find a better entry, it would be best to use your knowledge of these tools to analyze the current environment to help you pick a good stop loss point. As much as possible, you shouldn't really rely solely on Fibonacci levels as support and resistance points as the basis for your stop loss placement. Remember, stop loss placement isn't a sure thing. Stop loss is probably one of the most important parts of your trading and should be fully evaluated, because what you're always trying to do is minimize your risk and your exposure. And Fibonacci's on their own can't do this for you. Fibonacci retracements are often used to identify the end of a correction or a counter trend bounce. Corrections and counter trend bounces often retrace a portion of the prior move. While short 23.6 retracements do occur, the 38.2 and the 60 cover the more probabilities with 50% in the middle. The zone may seem big, but it is just a reversal alert zone. Other technical signals are needed to confirm a reversal. Reversals can be confirmed with candlesticks, momentum indicators, volume, or chart patterns. In fact, the more confirming factors, the more robust the signal. So remember, Fibonacci tools or Fibonacci levels are simply a different way to give yourself an alert. Too many traders think that they're gospel and that this is what they should be doing, or when it hits a 38 level or a 50, that these are trading signals. They are not. Fibonacci's, if you use them correctly, are great alert tools, telling you something might happen at this level, just like a trend line. A trend line simply tells you that the price should be supporting this line. It can be broken at any time, but as you see price coming down to that trend line, you're expecting that trend line to support that price and keep it above. But it's telling you, okay, the trend line and the price are now moved together. We should expect some type of market action or reaction. So be alert, be prepared. And that's all Fibonacci does. It gives you one more way to build yourself with trend lines and support and resistance alert zones where you are ready to make a calculated decision. Because what you need is something tapping you on the shoulder saying, hey, buddy, there's a trading potential out there. So now it's tapped you on the shoulder and said, look, there's a trading potential. Now you have to determine what and where that potential is and what to do with that alert. So remember, don't put the gospel in the Fibonacci levels. Use them as simple alert zones to tell you that something may be happening with the current trend. And on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. And go to www.tradetime.com and set up an account, a demo account with them. Use Fibonacci levels on their charts and watch their videos on how to use Fibonacci's successfully. So have a good evening, and thank you once again. Good night now.